All right, let's get into it. Today, we're going to unpack the single most powerful idea from one of the greatest investors ever, Warren Buffett. It's actually a really simple metaphor, but trust me, it's the absolute key to how he built his entire empire. So, where does this all come from? It all starts with this almost ridiculous question someone once asked Buffett. How can I make $30 billion? I mean, come on, that question is so huge it sounds like a joke, right? But Buffett's answer wasn't some complicated financial formula. Nope, it was shockingly simple. And this was his answer. This snowball, this one simple image, it's the key to his whole philosophy. You see, his success wasn't some overnight lucky break. It was all about starting a tiny little snowball of money and letting it roll down a really, really long hill, just gathering more and more snow with every single turn. Okay, so let's break this down into three core principles. First up, let's talk about the snowball effect itself. We really need to understand what makes the snow sticky, and more importantly, why the length of that hill is the real secret sauce here. So, what is this sticky snow he's talking about? Well, it's compound interest. That's the engine driving this whole thing. Think about it like this. Your first investment makes some money. Cool. But then, that money you just made starts making its own money. It's a really slow burn at first, but over time, it just creates this insane feedback loop, grabbing more and more snow as it keeps on rolling. And this brings us to Buffett's number one most crucial ingredient, time. That snowball needs a very long hill to get truly massive. And this really means one of two things. Either you start investing when you're super young, giving your money decades and decades to grow, or, well, you live a very long time. Time, more than any big initial investment, is the most powerful force in this whole game. Okay, so we get it. Compounding is powerful. But how in the world do you find the right snow to pack into that ball in the first place? Well, that brings us to principle 2. Buffett's incredibly practical, systematic approach that he calls the A to Z method. Now, this is not some glamorous, high-tech strategy. Buffett says if he were starting out today with just $10,000, he would literally, I mean literally, start with companies whose names start with A and just work his way down the alphabet. So why would he do that? Because he'd be looking at all the smaller companies, the ones that the huge Wall Street funds totally ignore because they're just too small to make a difference in their giant portfolios. That means less competition and a way better chance of finding a hidden gem. The key here is you're not just buying stocks, you're buying into good businesses, solid companies with a future, and you have to get them at an attractive price. It's all about doing the grunt work, the heavy research. And this quote just brilliantly shows you how timeless his strategy is. This isn't some hot trend for 2024. This isn't a fad. According to Buffett himself, this fundamental advice, buy good businesses at fair prices, is going to be just as true 100 years from now as it is today. That's what it's all about. And now for our third and final principle. And you know what? This one might just be the hardest of them all. Because even if you do all that methodical work from the A to Z method, even if your research is perfect, there's absolutely no guarantee that anyone else is going to agree with you. And that's where the psychology comes in. You have to have the courage to trust your own work. So really get this, let me tell you a quick story from way back in his career. Picture it. It's 1951, and a young Warren Buffett discovers this little insurance company called Geico. He just dives headfirst into the research, falls in love with the business, and he is 100% convinced he's found gold. He's so fired up, he takes his findings to the top insurance analysts on Wall Street. And what did they do? They basically laughed him out of the room. And right there, that's the conflict. On one hand, you have Buffett's own intense research telling him he'd found something truly special. And on the other, you've got the so-called experts telling him he's nuts. So what do you do in a situation like that? Who do you listen to? This is the lesson. This is the punchline. You just can't wait for other people to agree with you. You can't look for validation from the crowd, not even from the experts. If you've done the homework and you believe in your analysis, you have to have the guts to act on it. You have to think for yourself. So let's pull all this together. Let's see what this actually means for building your own investing snowball. How do these three principles lay the foundation for real success? So here it is, the whole playbook. First, you have to harness the incredible power of compounding by giving your snowball the longest hill you possibly can. Remember, time is your best friend. Second, do the actual work. Go through the process, find great businesses selling at fair prices. And third, and this is crucial, have the mental toughness to trust your own conclusions, even if you feel like you're the only one who sees it. And that leaves us with one last really important question. The principles, they're timeless. They work, but they don't do anything without action. That snow is not going to start rolling by itself. So the question isn't just how to build the snowball. The real question is, what long hill are you going to choose for yours, and when are you going to give it that first push?